When you are investing in stocks for the long term, the first critical factor to check is the lifespan of the products or services offered by that company. The product should be in use for at least next 10 to 15 years. The last thing you want, people do not need that product anymore and the company ran out of business. Further, if you want to make good profits from the stocks in long term, then make sure that you are investing in the growing sector. That's what we are going to discuss in today's video. Investors, welcome to Value Multicaps. Value Multicaps, SEBI registered stock advisory firm. With this video, we will explain you how these 5 sectors in Indian stock market carry potential to create wealth in 2019. Be sure to hit the red subscribe button and the bell icon next to it so you are the first one to know when we upload a new video. In our stock subscription services, we selected various blue chip companies from this sector for our paid subscribers and multi-bagger stocks from our mid-cap and small-cap universe. First sector, consumer goods and FMCG. Will the people still be using soaps, shampoo, electronics 15 to 20 years from now? Definitely yes. Consumer goods sector depends heavily on consumer behavior. This sector includes companies involved in food production, packaged goods, clothing, beverages, electronics. Unlike many sectors which follow the contraction and expansion cycle, FMCG products will always be in demand. During a recession or economic crisis, people may not buy a new automobile or might not take a new loan or avoid investing in real estate. But because FMCG products are basic necessities, they will always be in demand. Key positive triggers are rural demand picking up. Rural people significantly consume consumer products, especially FMCG products these days, and the trend is rising day by day. Unorganized sector losing share to benefit the organized players after GST due to migration towards branded products. Automobile sector. The Indian auto industry became the 4th largest in the world. It was the 7th largest manufacturer of commercial vehicles in 2017. It is also a prominent auto exporter and has strong export opportunity expectations in the near future. It is expected to grow at a CAGR of 3% during 2016 to 2026. The government of India allows 100% FDI in automobile under the automatic route. The industry has attracted FDI worth $19 billion during the period 2000 to 2018. Key positive triggers are increased spending by government to revive rural India, MSP hikes also to result in higher purchasing power with farmers. Construction sector. Infrastructure and construction companies are the key players in the growing countries. We already noticed the continuous work in building new airports, railway stations, metros, which is going around us. In general, there are 3 subsectors of construction: building, infrastructure, industrial construction. Building divided into residential and non-residential. Infrastructure, heavy civil or heavy engineering that includes large public works like dams, bridges, highways, roadways, waterways. Industrial construction, it includes refineries, process chemical, power generation and manufacturing plants. Construction industry is the 2nd largest employer after agriculture, employing more than 35 million people. Among the key flagship schemes where the initial work has commenced include road projects, affordable housing, Build New India and sizable investment in railway electrification. This massive fund infusion and rising growth momentum will provide a significant demand for companies in the sector. Banking and financial services. The sector that provides financial services to commercial and retail customers. It comprises of commercial banks, insurance companies, NBFCs and mutual fund companies. Most important, housing finance companies or NBFC are going to play a crucial role in the growth story of India. This is easily one of the best sector for the long-term investment. Unlike major public sector banks, housing finance are performing very well. They have actually a low NPA as compared to the PSU bank. Key positive triggers are real GDP growth is expected to revive at a moderate pace in 2019. Private sector banks gain market share in deposits and loans. Retail asset growth and asset quality still healthy. Most large private sector banks have a strong liability franchise with high percentage of low cost deposit. Pharmaceutical industry. It's really impossible to ignore pharma when we discuss long-term equity investment. India is the largest provider of generic drug globally. Indian pharma sector, the industry supplies over 50% of global demand for various vaccines, 40% of generic demand in the US and 25% of all the medicines in UK. With the evolving technology, pharma companies are investing heavily in R&D activities. Presently, over 80% of the drugs used globally to combat AIDS are supplied by Indian pharma. The pharma industry was valued at 33 billion US dollars in 2017. The country's pharma industry is expected to expand at a CAGR of 22% till 2020 to reach up to 55 billion US dollars. India's pharma export stood at 17 billion US dollars in 17-18, while in 2018-19 these exports are expected to cross 19 billion US dollars. Key positive triggers are faster approval by US FDA will lead to more opportunities for Indian companies in low competition products. After disruption in domestic market due to GST, growth is recovering. We expect that domestic pharma market growth would be in low double digits in the medium term. Remember to sign up into our website valuemulticaps.com if you want to have free stock market research report and newsletters with hot stocks on fund manager and analyst radar. We will love to see you in the comment section and in our email inbox as well. Thank you.